Welcome to Session 1 of Financial Accounting I. Today, we'll be diving into crucial concepts, the meaning of depreciation and amortization, their causes, factors determining the economic life of an asset, and various methods for calculating depreciation. This session is prepared by Nandish Kumar KC, Assistant Professor at Government First Grade College, Hiryadka. Let's begin by understanding depreciation. Depreciation can be described as a permanent, continuous, and gradual decrease in the book value of fixed assets. It's important to note that this is based on the cost of assets consumed within a business, not on their market value. According to the Institute of Cost and Management Accounting, London, or ICMA, depreciation is the diminution in intrinsic value of the asset due to use and/or lapse of time. To illustrate, imagine you purchase a machine for 1 lakh rupees. If this machine is expected to be useful for 10 years, you might depreciate it by 10,000 rupees each year. This means that after 1 year, its value in your accounting books would be 90,000 rupees. Moving on to amortization. Amortization refers to writing off the cost of intangible assets. These can include assets like patents, copyrights, trademarks, franchises, and even goodwill, all of which have a utility for a specified period. What causes depreciation? There are several key factors. Firstly, wear and tear due to use or simply the passage of time. Secondly, the expiration of legal rights can lead to depreciation. Thirdly, obsolescence plays a significant role. This can stem from technological changes, improvements in production methods, or even a change in market demand for the product or service the asset produces. Finally, abnormal factors can also contribute to depreciation. The useful life of an asset is influenced by several factors. It can be predetermined by legal or contractual limits, such as the period of a lease for a leasehold asset, the number of shifts for which an asset is used, the repair and maintenance policy of the business organization, technological obsolescence, innovation or improvement in production methods, and finally, other legal or restrictions. Now, let's explore the common methods for calculating depreciation. The two primary methods are the straight-line method and the written-down value method. Under the straight-line method, a fixed and equal amount is charged as depreciation in every accounting period throughout the asset's lifetime. The formula for calculating depreciation using this method is: depreciation equals the cost of the asset minus the estimated net residual value, all divided by the estimated useful life of the asset. The rate of depreciation is calculated as the annual depreciation amount divided by the acquisition cost, multiplied by 100. Let's look at an example. If the original cost of an asset is 3,50,000 rupees, its useful life is 10 years, and the net residual value is estimated to be 50,000 rupees. The annual depreciation would be calculated as 3,50,000 rupees to 50,000 rupees divided by 10, which equals 30,000 rupee per year. Next, we have the written down value method. In this method, depreciation is charged on the book value of the asset. Since the book value continuously reduces with each annual depreciation charge, this method is also known as the reducing balance method. For example, if an asset's original cost is 3 lakhs rupees and depreciation is charged at 10% per annum on the written down value, in the first year, depreciation would be 3 lakhs rupees multiplied by 10%, which is 30,000 rupees. The written down value at the end of the first year would then be 2,70,000 rupees. In the second year, depreciation would be 2,70,000 rupees multiplied by 10%, resulting in 27,000 rupees. The written down value at the end of the second year would be 2,43,000 rupees. Let's compare these two methods. Basis of difference: straight line method, written down value method. Basis of charging depreciation: original cost, book value, annual depreciation charge, fixed, declines year after year, total charge against profit and loss account almost equal every year, increases year after year, recognition by income tax law, not recognized, recognized, suitability, suitable for assets with low repair charges, low obsolescence possibility, and scrap value dependent on time. suitable for assets affected by technological changes and requiring more repair expenses over time. Finally, let's briefly look at how depreciation is recorded. At the beginning, for recording the purchase of an asset, asset account debit to bank vendor account credit at the end of every year. A. For charging depreciation, depreciation account debit to asset account credit. B. For transferring depreciation to the profit and loss account, profit and loss account debit to depreciation account credit. For further reading and in-depth understanding, you can refer to the following texts.